Hey everyone, welcome back to Corporate Decoder. Today we're diving into the latest annual report of Cactus, Inc., ticker symbol WHD. This report is full of interesting stuff, including how changes to climate policy can affect business. It also includes some risks that can impact your wallet if you choose to invest. This is their Form 10-K, an annual snapshot for the year ending December 31, 2024. It gives investors a deep look into Cactus's performance and potential future. Cactus is worth a lot. As of June 2024, the value of their common stock held by folks not directly involved with the company we're talking the public was roughly $3.5 billion. Cactus Inc. started in 2011. They design, build, sell, and even rent out fancy pressure control and pipes for oil and gas wells, mainly those onshore unconventional ones. They also offer services in the field for these products, like installation and maintenance, and operate in places like the United States, Canada, and even Australia, with manufacturing hubs in Louisiana, Texas, and China. In early 2023, Cactus made a big move by acquiring FlexSteel. They make reinforced pipe used in the oil and gas industry. The company hoped FlexSteel would help them do better, but acquisitions are always risky, so it's important to check out if that's the case. The business has a specific structure. Cactus Inc. owns most of the company, a whopping 85.6%, but a group called CC Unit Holders owns the remaining 14.4%. A key owner, Cactus WH Enterprises, is run by some folks who have been in the wellhead business for decades, the Benders. They still have a significant say in how Cactus is run. Cactus divides its business into two main areas. First, there's pressure control, which handles wellheads and related gear. Then there's spoolable technologies, which focuses on flexible pipes used to move oil and gas. Each segment caters to slightly different needs in the energy sector. The demand for pressure control is driven by the number of new oil and gas wells being drilled. Spoolable technologies depends on wells that have already been completed and are ready to start production. In 2024, product sales were 75% of their income, rentals 9%, and field services 16%. This has shifted a little bit because before, in 2022, product sales were at 66%, rentals were 14%, and field services were 20%. They're less reliant on rentals and services and more on sales than before. The materials Cactus uses, like steel and specialized components, come from all over the world. The United States, China, India, Australia, and Vietnam. So they aren't overly reliant on one particular supplier, which is a smart move. Cactus makes sure their products are certified to meet certain standards in the industry, like those set by the American Petroleum Institute. These certifications are kind of like having a quality stamp of approval, so customers know they can trust the products. Here's a fun risk. Cactus has to make payments for certain tax benefits they may claim, and these payments could be significant and may continue to increase their obligations in the future. Also, certain investors have more control than others, which may impact the stock value. As of December 2024, they have around 1,600 employees across the globe. Workplace culture. They employ a diverse workforce, which is about 10% women and approximately 46% representing a minority population. Their safety record, measured by something called TRIR, is pretty good. This number tells you how many incidents happen per 100 workers. Cactus is in line with the industry average, so they seem to be managing workplace safety well. Their environmental stance. The company has to comply with a range of environmental laws that affect the business, and changes to these laws or an increased focus on climate change could hurt Cactus business and financial results. The business has a repurchase program to buy back some of their own stock, which can boost share value and help to return value to the shareholder. Since then, they haven't purchased many shares. This might be something to keep an eye on for the future, and in particular, something for the executives to address. Alright, let's quickly run through the financials. Revenue increased slightly. However, for pressure control, their bread and butter sales actually dropped. Spoolable technologies made up for it. Their operating income is up. They're making more relative to how much it costs to run the business. The big jump here came with interest income going way up, and that's because they've got cash sitting around, not debt. They went from paying interest to earning it, and we like that. One thing to note, they may have to make payments that are higher than they actually save on taxes based on a specific agreement. This is a tricky point to keep an eye on, as it might impact them in the future. Of course, world events like the Ukraine war and other military actions will have an impact. These conflicts introduce uncertainty in oil prices and the supply chain. They could also lead to cyber attacks. The company's cybersecurity program is also interesting. The director and VP of Information Technology meet with the executive team to discuss and review risk related to cybersecurity. The audit committee reports significant findings from these reports to the full board of directors. They've dealt with cyber incidents. However, those incidents haven't materially affected the company's business strategy, results of operations, or financial condition. This may change, however. Now for a quick look at leadership. The top dogs at Cactus are the Benders, Scott and Joel. They're the CEO and president. They are not alone, however, in a well-diversified team of executives. The accounting firm PricewaterhouseCoopers gave Cactus a thumbs up, meaning they believe the financial statements are fair and accurate. However, it's worth noting a critical audit matter. The liability related to the Tax Receivable Agreement, or TRA. Now, let's zoom out and put all this information together. Cactus, Inc. operates in a cyclical industry and is at the mercy of oil prices and the global economy. The acquisition of FlexSteel appears to be a smart move that is providing diversification, but it is also creating some tax risk. Despite global issues and cost pressures, the management has delivered solid results. Looking ahead, you might want to watch how they keep managing costs, navigate regulations, and handle the risks from all that debt and those tax payments. However, it's worth taking a step back and zooming out. It's an incredibly concentrated portfolio compared to what other businesses might have. This might not be the best move if oil is not something you are confident investing in. Thanks for watching. If you found this breakdown helpful, don't forget to like, comment, and subscribe for more deep dives into the world of corporate filings. Let me know in the comments which companies you'd like me to decode next.